Let's talk about the sector of the day that's really stealing the thunder and how. And I am talking about OMCs. If you look at BPCL, I mean, the gain is 10% now. That's what we're looking at. Let's go across to Sonal and understand beyond the momentum and beyond the excitement around budget, etc., whether there's anything sector-specific that could be behind this move. Sonal?
Well, thank you for that. You know, all marketing companies outperformed last year and that outperformance continues now as well. Yesterday in the budget, the government said that they are talking about putting off the equity infusion in state oil companies till next fiscal. This was an overhang, something that all the brokerages spoke about in the results as well, and that has been put off till next fiscal. But if we look at the returns on these stocks, year to date, HPCL is up 23%, we have BPCL up 23%, IOC is up 24%, and HPCL is up 15% this week, which is the best week in 2 months. BPCL is seeing the best single day since July 2020. It is up 17% this week, which is the best in 3 years. And Indian Oil is seeing the best single day gain since January 2013. This is the best week since May 2024. So we are seeing this big move coming in across the three names. Now, in terms of valuations, all of them trading anywhere between 8 to 8.5 times. This is 1 year forward earnings, and they are now trading at 11 to 15% premium to their long-term average. Now, they have some of the triggers going forward in terms of their capex, in terms of their refinery expansion. For HPCL, it is a long list. They are raising their refinery capacity both at Vizag and Barmer. They are planning to invest 75,000 crore rupees over the next 5 years. They are forming a wholly owned green subsidiary. They are also talking about lubricants demerger. Some of them are yet to be commissioned, and that is something which will be the next trigger. BPCL is talking about 1.5 trillion capex in next 5 years. They've also signed an MOU with subsidiary of Tata Motors to set up EV charging stations. So that is something that they are getting into now. IOC has some capex to be completed, 3 refineries which will see expansion and will be commissioned as well. So there's a lot happening in terms of refinery capacity addition and getting into the renewable sides of business as well. So that would be the trigger. But as I said, the putting off of the capex or the equity infusion from the government, especially in BPCL and IOCL to next year, which was an overhang, is not there anymore. So we'll watch out for details next year. And of course, it's a general election year. So anything in terms of marketing margins is also something we'll be watching out for.
Sonal, when you speak with analysts who track the sector, is there a general belief that, by the way, I was surprised when you said, I mean, they're only 10-15% higher than long-term average. I mean, after the rally, I thought the gap would be much larger, but is there a belief that, I mean, they should now be trading at much higher P multiples, because there is that effect also that, I mean, you know, what do you get at 8 and trading at under 10 times earnings? So is that a sense you get? Yeah.
The case has been that all these oil marketing companies have always been trading at these levels. BPCL once traded at 11 times. That's when we were having those divestment talks, and it became the most expensive refinery stock in the world at that point in time. But it has come off from those levels. But yes, like any other public sector undertaking, they are still very cheap. They are still very reasonable. But nobody really believes that it should be above that 10 times level, because right now they are way higher, as you said, than their long-term averages. So analysts are comfortable with these levels on stock prices.
Okay, by the way, since we're on the subject, I'm just looking at a Fitch note on OMCs that's hit my inbox right now. And Fitch is saying that after a great FY24, expect OMCs leverage levels to start rising and maybe returns to start moderating. And why do they say that? They're saying moderating profitability, rising capex for, of course, the energy transition projects that they're incurring. And perhaps some moderation in margins as well. But that's Fitch for you, saying that maybe the coming financial year won't be as good in terms of just the business, dynamics as FY24 has been. That's one more view, Fitch. But thank you very much, Sonal, for giving us the update today. The stocks are absolutely roaring up and away. Prakash Diwan is...
Thanks for tuning in to CNBC TV 18. And for more news and updates, follow us on all the social media platforms.